Despite the recent declines, our next guest says this is a buying opportunity and that the bull market is not over. Joining us now is Julian Emanuel, Evercore ISI Senior Managing Director, Equity Derivatives and Quantitative Strategy. Julian, always great to see you and to have you on the show. So let's start right there, Julian. You say you've got confidence. This bull market, it's not over. This current correction, it's a buying opportunity. What gives you that confidence, Julian? Walk us through it.
Well, first of all, in talking with clients and looking at the data and thinking about how people are positioned, the sentiment can best be described as abjectly miserable. Okay. And frankly, when you look at how markets trade, when pessimism is rampant as it is, when the data, the soft data, the attitudinal data has deteriorated, but the hard data, the actual on-the-ground economic data, is still holding in, small cracks, but still holding in. In our mind, all of this adds up to the potential for the bull market not being over, this being a buying opportunity. And frankly, today's action was much more positive than I think any of us could have hoped, looking at the way the day started.
Well, and Julian, to your point about the soft and the hard data, there's been so much discussion about that recently. Jay Powell, the Fed chair, of course, talked about it this week. He says the survey data, the confidence data, doesn't always translate into spending, right? It doesn't always mean what people say and what they do can sometimes be two different things. That said, when you're looking at the hard data and we're only seeing cracks, what would you see that would get you more concerned there? What are you watching most closely?
Julie, the thing that has been and continues to be the most important is the labor market. And we put a lot of stock into that high frequency Thursday at 8:30 a.m. New York time jobless claims data. And it has stayed very steady in the low 200,000s. To us, the real test is going to be over the next 4 to 6 weeks when the DOGE cuts certainly hit the public sector. What's the bleed over into the private sector jobs data? And we're all holding our breath, but it is our opinion that while it's going to certainly, set that data on a bit of a higher course, we don't think that you're going to have a situation where you're likely to see abject negativity, which we would define by weekly claims exceeding 300,000, which tells you that a downturn would be right around the corner. It's not going to be nearly that severe in our view.
So, Julian, so there's so many viewers who are watching right now, and let's say, what is your advice to those viewers? They want to stay invested. They want to stay invested in this environment. At the same time, we're in an environment where we have these headlines constant, a lot of drama, a lot of noise, a lot of emotion. How do you try to stay focused and look through that?
So actually, I believe there was a movie that's being released this week called Tune Out the Noise, about index funds and the development of that strategy over time. And we would encourage investors to tune out the noise as much as is humanly possible. And it is difficult, granted, and certainly for a professional investor, you really can't do it. But the fact is that the long-term trend for equities in our mind continues to be positive, driven by the idea that you aren't likely to have a recession this year, and you are likely to have earnings that are sort of on the order of 8 to 9% growth year over year. And you have a Fed that is not going to hike rates under any circumstance and is more likely to cut rates. All of that means stay invested. And if the day-to-day volatility is too much, we would suggest rotating towards stocks that we deem, we call it our all-weather outperformers, stocks across industries that are likely to have solid enough fundamentals at attractive enough valuations after this sell-off that they're likely to do well, whatever the range of uncertainty is the next 12 months.
Of course, Julian, you're also aware that a lot of investors have been looking outside of the U.S. for the first time in a long time, right? And I was struck by a chart that Joe Weisenthal of Bloomberg posted today where he looked at the ratio of U.S. stocks to the rest of the world as measured by a couple of ETFs. And U.S. stocks have just been incredibly dominant for the last, call it, decade and a half, until recently, where that ratio has kind of reversed and directionally gone a little bit the other way, where there's been some rotation. Are you also looking at that kind of trade, or do you still want to be all in on the U.S.?
We are looking, and frankly, the conversations that we've had recently really do lead us to believe that you are potentially on the cusp of what we would call a multi-quarter, perhaps even a multi-year point of rest of the world outperformance. But there's two things to understand here. Number one, that is generally contingent on a peak in the U.S. dollar, and we actually do see that developing, simply because when you look at interest rate differentials between the rest of the world and the United States, they're compressing. A lot of that as a function of the fact that Germany now all of a sudden has to spend a lot more to rearm itself. So you're seeing interest rate yield differentials collapse and compress. You're seeing the dollar really come off its peaks. That's very good for rest of the world stocks. Now, is this a time to just go out hand over fist and buy those and sell U.S.? It isn't, okay? People have been underweight the rest of the world for a long time. We'd say address that underweight. But importantly, you have a weaker dollar, you have the AI story, and you have sentiment so negative in the U.S. that it is likely a time, again, that the U.S., even if it ends up on a year or two basis, underperforming the rest of the world, it will likely rise as well.
Julian, I just want to get your thoughts quickly about gold as well. You know, it looks like it retreated here. Spot bullion fell about 1%. Still up for the week, though. It's climbed about 15% this year. What is the message, Julian, the metal is telling investors?
It's actually a very mixed message. What's interesting about this run in commodities is gold has gone above 3,000 to the ounce, clearly being backstopped by demand by global central banks and sovereign wealth funds. China has been a buyer very frequently. It's a diversification play, given the uncertainty that we have geopolitically. Look, it's one of those things that if it makes you sleep better, it should be a tiny part of your portfolio. But again, from our point of view, the best asset to own long run with regard to inflation, with regard to actually paying real dividends, are equities.
Sticking with equities here. Julian, always great to see you. Thanks very much.
Thank you. Have a great weekend.